Good. So I'm so glad you got on here with me today. Thank you so much.
You're welcome.
I know we both have insane schedules.
No, it worked out good. It's good timing. My house is empty, so it'll be very quiet.
Awesome. Well, my house is not, so I'm praying for quietness. So, but I don't want to take up too much of your time today. So let's get started. You want to introduce yourself and what company you're with?
Sure. So my name's Jake McPherson, and I'm with First Community Mortgage, which is technically a bank. It's based out of the Tennessee, Murfreesboro, Nashville area. But we have mortgage offices kind of around the Southeast, and I live down in South Georgia in Coweta County. So
perfect. And just for all the people that's going to be watching this video, he is definitely my preferred lender. I send all my buyer clients to him. I've used him myself, and so I know he's a great lender, not just from a business experience, but from a personal experience.
Thank you.
You're welcome. So what loan options are available right now, especially for first-time home buyers or families?
So there's a plethora of different loan options, right? You have conventional and FHA and VA, USDA, all these different acronyms for different things. But specifically for like first-time home buyers, there are actual like first-time home buyer programs that kind of help alleviate some of the down payment requirements. They have more favorable interest rates. They even have like more favorable, not just interest rates, but like mortgage insurance costs, different things. And there's a bunch of them. And it really kind of depends on somebody's situation, like what their credit is, if they have a down payment, which one they would probably be best suited for. And so the best thing anyone can do if they are a first-time home buyer is let that be known, like when you're having that initial conversation with a lender, and then kind of letting them let the lender lead that conversation of like, here are your different options, but always ask to see them all. Even if they say, well, I recommend this one, that's great. But still, in my opinion, it's worth seeing maybe one or two of them just to make sure that it's like, okay, that makes the most sense for me and my family.
Okay. And so would you say for a first-time home buyer, because I am noticing even in my business, a lot of people have no idea about the different types of loans, if they can afford a house, and they will just immediately jump into renting again. So would you say for a first-time home buyer that if it can be done, if it's at all possible, you have a program to get it done?
Yeah, absolutely. It's one of those things too, where the conversation, like to at least invest it, it's free. There's no cost. It might take a little bit of your time, but it's worth having the conversation because let's say it's not the right time, right? Everybody always says it's always the best time to buy a home. That's the case for like 99% of people. I would agree. But there's about 1% where it's like, hey, you might need to do a few things beforehand. Mm-hmm. And you're never going to know unless you have a conversation about it. And I know it's hard to put yourself out there and maybe feel embarrassed about credit score, about, financial situation. There's no need. It is a non-judgment zone where it's like, we're going to have a very, I would say black and white, like here's what we can do. Here's how it can be done now. Here's how it can be done better if you want to work on a few things to better the situation. But unless you have somebody that's going to like tell you exactly how to do it, it's really overwhelming to kind of just be like, I don't know where to start, right? And that analysis paralysis of like, I don't know what to do, so I'm just going to keep doing what I've always done, even if it might not be the best situation. And so it's worth having the conversation, and, it might take 20 minutes just to talk through a situation and figure out like, hey, there's a real possibility here, and let's talk through it and investigate it. And, if it doesn't work out now, you know how to make it better for down the line, or, 2 or 3 months down the line, you're finally ready, even with the exact same situation, and you move forward.
Exactly. And that's one reason that I really do love working with you, is because of the fact, and this is for me and my business as well, our clients are not just another transaction. We truly want to help them. And I always feel like with my clients, you never rush them into a situation where they get in and they buy a house and then they're struggling and then they lose it in foreclosure because they can't pay for the property. You're very upfront, and I love that.
Yeah.
And you're not afraid to tell people, yeah, it's not the right time.
No, I mean, like I said, if you're renting, you're paying 100% interest, you're paying somebody else's mortgage, you're not building equity. There's a plethora of statistics that show that the best way to increase the normal person's net worth is through home ownership. And so I fully agree with that, but I could never in good conscience say that everybody should buy a home at every stage of their life. And so it's a matter of like, if this is a long-term goal for you, let's see how long-term it is, or can it be accomplished today? And even if it can be accomplished today, but it doesn't feel right in the sense that like that payment, I can't find a house with that payment that I'm trying to look for, or, we just went through something and so I don't have the cash needed to do this. That's fine. But now you at least have a goal to work towards, and it's on a piece of paper, right? You can look at it and say, hey, I need to get to here. I need to pay this thing down, and then I'll be ready. And then it's on your schedule, right? Like, I don't want anybody to be like, I got to do this the next week. Sometimes it takes a little time for you to get there, but at least you always have a easily readable place to go and look at it and say, I know what I need to do, and it's a goal of mine, and I'm going to accomplish it.
Exactly. And so earlier you mentioned how it can be overwhelming for people that maybe have never bought a house before when they get into the market, because it's very different than just paying first and last month's rent and renting a home. So in easier terms, how would you best describe the difference between the loans, conventional, FHA, VA, and USDA?
I would say the main difference between them all is the amount of down payment you have to have. So how much money you need to bring to the transaction, and then how they view the criteria that we use to get somebody approved. So we look at, I'll break it down. We look at credit, we look at income, and we look at debt. And each one of those care more about one than the other. And so certain programs are better for people with low credit. Certain programs are people better with high debt, or low credit, high credit. They're different programs. And to break it down even smaller, the basic loan, a conventional loan, everybody has access to. The FHA, the VA loan, and the USDA loan, those are government-backed loans. The government actually helps cover a bit of the liability for someone. So they have different requirements. Some are, you can't get access to unless you're a veteran, or if the house is in an area that's designated USDA. But you've got government-backed loans, and then you've got loans for everybody. And everybody's situation's different. Some people are like, well, I don't know if I could get a government-backed loan. And it's like, well, you don't know unless you check and we have a conversation. But there are those four basic ones are part of what we offer. There's probably 25 others, everything from bank statement, foreign national, asset depletion. There is a loan for everyone, and not everybody is the same, especially in their financial situation. And so the benefit is, once you start looking at those situations, normally it's not just one. There's going to be 3 or 4 that you could theoretically qualify for. And that's my job, is to show you those and kind of walk you through it and say, here they are. Here's the pros and cons to each. Here's the monthly payments for each, because sometimes one might be $50 cheaper than the other, but long-term, it is not beneficial. And so I want to walk people through that. So that way, my goal, and you've heard this before, is by the time you're done with your loan, you will know more about loans than 99% of people. The only 1% you won't know you won't know more than is people that do it for a living, like myself. But everybody else, including your friends, your family, your parents, whoever, you'll be like, oh no, I know exactly how this works, probably better than you do.
Oh, that's awesome. 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 And so right now in today's market, are there any low down payment or zero down options that you recommend?
Yeah, I mean, there's right now is a good time for that. There are regular loans that have 0% down. There are loans that would theoretically say need a 3 or 3.5% down, but you can also then get down payment assistance to cover that 3 or 3.5%. Therefore, technically making it where you bring no money down. There's a lot of different options for that. And I will say, because there's so many options, it would really depend on somebody's credit, right? Their credit's going to open up either 1 or 2 or maybe 3 or 4. And then even locally, right, in the state of Georgia has down payment assistance programs. They have something called the Georgia Dream. That's a program for first-time home buyers that need help with qualifying. So not only do banks like the bank I work for have our own programs, there's also state and local government programs that you can kind of put them together, and it's like, oh wow, not only did we get this, now we got this, and together we've got everything.
Got you. Okay. And because I know with the interest rates being so high right now, or higher than they were, previously, a lot of people are freaking out because they don't have a lot of money in the bank. So
Yeah.
I think those programs would definitely be good. And can you kind of explain what's going on with the interest rates right now? Because I know even with myself, I was a little confused because of the internet and what Google says.
Yeah. So the way that interest rates, they move daily. If you think like the stock market, how you hear about, the Tesla has gone up or it's gone down. The bond market and the mortgage market is the same thing. It literally all day, every day you see it. If you looked at a chart going like this. And so what kind of moves that needle is economic data, right? They're really looking at inflation. They're looking at unemployment. They're looking at everything from like consumers' confidence in the economy. Like they take it even a step further. And so all of those things, like if inflation goes up, interest rates go up. If inflation goes down, interest rates go down. And so each one of those has like an indicator of what's going to happen. Now, you kind of mentioned things you see on the internet. One of the big things you see on the internet is they'll say, hey, these are what the average interest rates are. What they don't know is, are those interest rates that are, free, or are those interest rates that cost me money? Because the way it works is the going interest rate might be 7%. You can buy whatever interest rate you want, though. You could say, well, I want a 6% interest rate. Great. If the going rate is 7, I can charge you X amount of dollars, and it now becomes a 6. And so when you're looking online, they're seeing what are loans closing at. They don't know the details. They just say, what are they closing at? And because we're in a high interest rate environment, and also an environment where some homes are sitting on the market, sellers are helping pay buyers closing costs. And they're sometimes even helping buy their interest rates down. And so the internet will show, hey, the interest rate is 6.5. And then you'll call somebody and they'll say, well, the interest rate is 7%. When you'll say, well, I saw 6.5 online. Well, yeah, you can get a 6.5 and it costs $5,000. Then the question becomes, does that make sense, right? Does saving that money and spending extra money make sense? And that's something that I really pride myself on walking people through, because I will walk them through, like, does spending extra money to get a lower payment make sense? I'll break it down into monthly costs. And then I'll even have the conversation like, how long are you going to be here? What's your long-term plan? What do you feel about interest rates? Do you think they're going to go down? And we have those conversations so you can make a really well-informed decision versus just letting someone like me make the decision for you when I might know a lot about your financials, a screenshot of it, but I don't know what your long-term plan is for you and your family. I need you to help answer that, but I want to give you the information so you can answer in the best way possible.
Got you. And now you mentioned you could buy your rate down, but is it true that you can only buy it down to a certain, like I can't come in and buy my rate down to 3% again, right?
That's right. So it's funny. Theoretically, right? Like I have rates that go all the way to COVID lows, right? 3%. But interestingly enough, the federal government will actually stop you from being able to buy the rate down that full 3%. And the reason why is the federal government looks at loans and they know that there are costs to getting a mortgage. And they want to ensure that nobody is charged an excessive amount for any mortgage that they get. We've got regulations that stop us from, me having one price and John down the road having another price and his price costing you too much money. They want to protect the consumers or the buyers out there. And so they actually put a limit on how much money a mortgage can cost. And if you can imagine, if we're at 7% now, to buy all the way down to a 3 is going to cost a lot of money. And even if you say, that's fine, I have it and I want to do it, the federal government will say, that's not a good financial decision. We feel like you're being overcharged. And even though you're telling us you're okay with it, we limit that. And so a seller can help pay for it. You can help pay for it. You could get close, but eventually you will come to a point where it's like the seller can't give you any more money because there are limits on that. The government will limit how much you can spend. And so when you have a set amount of dollars, it can only go so far before we get too low. And it's like, even though I could give it to you and a bank is willing to sell you this, you're out of funds. No one will let you do this.
Oh, goodness. And do you offer rate locks? And when should a buyer consider using one? And also, is that something important that maybe a buyer should bring up, is that they want their rate lock?
Yeah. So normally what most people think of is they might not even know what a rate lock is. So really what that is when you are purchasing a home and you're looking at interest rates, like I mentioned, they move daily. So you might talk to somebody a week ago and they'll say, hey, my interest rate for you is a 6.75. And a week goes by and you call them back again and you say, hey, we found a house. We really like it. Could you send us some numbers on it? And now the rate is a 7. And they're like, whoa, what happened? Like, I didn't change anything. Like, my credit's still the same. My income's still the same. Like, what happened? Well, the market moves. And so at that now at that time, a week later, maybe something happened, from an economic standpoint, and now interest rates have changed. And so your scenario has changed. And what an interest rate lock is it is actually locking in the interest rate that you were told right then. And they're only good for a certain amount of time. You can lock for 30 days, 60 days, 90 days. We have locks that go all the way up to a year if maybe you're doing a new construction or something like that. And so the time when most people lock is when they go under contract. Now, we do have what's called a lock and shop, which means if you feel like you want to lock in right now, we can go through all the steps, get you fully pre-approved. We can lock in your interest rate, and then you can go shop knowing that interest rate's not going to change. That was really big during COVID because interest rates were so low. And right coming out of COVID, as interest rates were increasing, a lot of people were like, hey, I want to lock this in because I hear they're going to keep going up. We're in a little bit of a different situation now where rates are starting to move down. And so you'd hate to lock and then rates keep going down. We do have some options for that. But now is one of those times where most people are going to lock right when they go under contract because they've got a contract with a closing date and they have a property in mind. And so they want to be secure knowing that, like, hey, no matter what happens between now and closing, my 6.75 is not going to change. And you mentioned, should buyers be talking about that? And they should. I bring it up very early in the conversation, so that way they're aware of their options. But if you're talking with somebody else and they don't mention locking the rate, or they don't ask you about locking the rate, I would ask and say, hey, am I locked? Is this rate going to change on me? I don't want any surprises. I don't want a week from now all of a sudden my house cost me $100 more because you didn't lock it and I would have wanted you to because you didn't ask, or something like that.
Got you. Now, you did kind of mention the situation. But so what happens if we lock in a rate at like 6.75, but then it goes down to 6.25? Can you lower the rate before closing, or are you locked in because you locked in?
So every lender is different. Some lenders will not, right? Because they're taking on a risk, right? Like if they lock you in at 6.75 and rates go to 7.5, they're not going to call you and say, hey, mind if I take this up to a 7.5? The rates are different. So some of them won't do anything. Now, in my company, we offer what's called a float down option. Now, I'll be honest, if it's a 6.75, and now the rates before closing, and this would all happen before we close. Once we close, the rate is the rate. It does not change unless you refinance your whole loan. So if before closing rates go down to a 6.25, we do allow you to float down. Now, most of the investors are going to charge a small percentage to get there. And so what I mean is if the going rate is a 6.25 now, you might only get to a 6.375, one step up from that, because the investor, since they took on all the risks to not let it go higher, they're not going to give you the full benefit as if you didn't lock the loan beforehand. Now, they'll give you a big chunk of the benefit, but there still is a little bit of a discrepancy on how far down they will go. And so the nice thing is if you were comfortable with the 6.75, being able to go down is still great, even though you locked and took away all of your risk of it getting worse, and you still got a better one. But you might not get the same interest rate as if you had just gone under contract that day and I was quoting it that day. But the difference between that 6.25 and 6.375, might only be $20 a month. And if we're still moving that way, at the end of the day, you're probably getting closer and closer to refining anyways, which is always a good thing.
Yes. So, how soon do you encourage someone that is going to be looking to buy a house to speak with a lender?
Right away.
Okay.
I mean, if you have any inclination of, hey, I want to buy a home at some point in the future, you should call a lender right away. And it's not to say that talking to a real estate professional first isn't always a good option. You should talk to a lender first. That part, to me, it doesn't matter either way. But early on, you should talk to a lender, because one of the big things I always say is you want to know what you can qualify for. And then you also want to know what is a comfortable payment, right? Just because you qualify for something doesn't mean you want to spend that amount of money. And so, it's very easy in today's world to get on Zillow and just, scroll, like doom scroll, and be like, I love this house. I love this house. And you're looking at a $5 million house all of a sudden, and you're like, oh, that pool is just too small. And it's like, what, those are homes that you might not ever want to afford because the monthly payment would be outrageous. And so what I like to do is say, talk to a lender early, because if we can get you figured out on what you want to spend monthly, and then I take that and say, all right, if you want to spend $2,500 a month, that turns into a $450,000 mortgage. You can then go and look at homes that are in that price range. If you just start going to look at homes, you might go look at a $500,000 home and fall in love. Yes, you could qualify for it, but now you're emotionally attached to making a decision that's probably not within your budget, and you're going to have to stretch for it. And you start to have these like conversations with yourself, like, we can do this. We'll eat ramen every day. And it's like, that's not the situation I want you to be in. I want you to be comfortable and find a house you love versus getting emotionally attached before you ever figure out the numbers. And so I always say the earlier, the better. So that way you can go in and make really confident offers and win on the dream home right away versus finding a home, losing out on it because you weren't pre-approved, having to go find another home, always dreaming about the last home. If we can get you started early, we can make sure that you're in a position to win on the first home that you see and you love.
Yes, I agree. And whoever you talk to first, whether it be a realtor or a lender, we're both going to point you to the other person.
That's exactly right. I'm like, so do you have somebody you're working with, or?
Exactly. And so what is the minimum credit score needed to qualify for any type of loan? Like, what will you not work with?
So it does vary. I will say once you get below every those loan types that we discussed earlier, conventional, FHA, VA, USDA, they all have different limits. The VA, I'm trying to give you the lowest number they will go, but like FHA will do 580, but sometimes they will go lower depending on the situation, right? Do you have a really good income? Do you have really good assets? Then they're willing to make exceptions. The VA will go down. I don't even think they publish a minimum because they are like, hey, it's all based off of a bunch of factors. And so even if you're sitting at home and you're like, well, I think my credit score is a 560, thinking you might look at Credit Karma, you might look at all these things that are online, the FICO score on your credit card. Those are not always entirely accurate. Mm-hmm. So just because you think you have a credit score at 560, and you're like, oh, I can't do anything, my credit's too low. Well, you don't know, because you'd have to go to a credit agency and get an actual pull of your credit. And you can do that yourself, so you can really see what it is. But what I would recommend is still doing the application, allowing someone like me to do a soft pull so we don't hurt your credit, and we can look at it and actually run the scenarios, because you might be surprised. I've had people that were like, well, I have a 565 credit, so I don't think I can do anything. And I'll look at a program and I'll run it through the system, and the system will be like, no, this is fine. We like it. It's fine. And you're like, look, you can wait. If you really want to get to a 580, it might help your interest rate and save you $30 a month. But if you're ready to go, we can go now. And so that's why I always say, like, it's worth the conversation, because the minimums that are published aren't always the actual minimums, especially when it comes to low credit individuals.
So especially, like, for example, if they didn't have any debt, their credit was low because of past debt, then they could qualify.
Yeah. I mean, and even if you have a lot of debt, but you've got really good income to debt ratio, right? Like, you've got a bunch of debt, or some of that debt from COVID times was late and delinquent, but since then it's been really positive. Like, you went from the 500 to the 565. That's really good movement. It's showing that all of your recent stuff is being paid. It takes time to get up to the 600s and 700s, but it doesn't mean that you're out of luck till you get there, because the systems that we use and the underwriters are going to look at that and be like, look, we got some old bad debt. We've got a lot of really good positive debt, and their income's been really solid, and they've got assets or reserves, which reserves would be like, you don't want to use your 401k, but you have one, and it's there to show that if you ever came into a rough situation, you could use it. You don't want to, but you could. They're going to look at that and be like, look, we've got really good reserves. We don't need them to get this done. But if anything ever got hard for them, they've got money somewhere. And a lot of people have a 401k from a company that, they're not touching, which is great. And that will grow, in that $20,000, $30,000 sitting over there could be the difference in qualifying and not qualifying.
Oh, wow. I did not know that. Okay.
Yeah.
And I was going to ask something. Oh, so I know a lot of people that come into buying or selling a house, they think that the realtor knows everything. And sometimes I get a lot of lender questions, and I'm like, well, I don't deal with money, but I have found myself telling people that you need at least a 600 credit score to even be worth wasting your time talking to anybody. So would you recommend that I get out of that habit and just straight up, just go talk to a lender? If you want to buy a house, just go talk to a lender.
Yeah, I would, only because if their credit, let's say, for instance, credit is like this like 800-pound gorilla in the sky, and nobody knows how it really works or why my credit score is going up or down when you don't feel like you're doing anything drastic. And so even it reminds me of a story and an example. I had a client that they had a credit score that was probably low. It was below 600, but it was probably in the higher 500s. And when they came to me, we ran credit, and I have a lot of tools on the credit side that will tell me, hey, if you do these 4 things, we can give you a 99% confidence that the credit score will go from a 565 to a 610. And if you do them, then that will happen. And so what I like to do is share that with the individual and say, hey, look, I don't know if you can do this today. I don't know if this will take you a month. But if you want to go ahead and do these 4 things that it has listed out, we are now able to do X, Y, and Z. It will change your situation. If we couldn't do a loan, now we definitely can do a loan. And for this person in particular, it was right during tax time. And so they got a tax refund check. And there was 4 items they needed to do. Their tax refund check was more than enough to do those items. And so the timing was perfect. And I was like, well, if you guys have that funds, go pay those 4 things to what it tells you to do. They did. I then got proof of that. They sent me, snippets that showed that they had paid those cards to what was suggested. I turned it into the credit bureaus. 72 hours, that's how long they have, later, they rescored them at a 610. And we went from being able to do nothing to 7 days later being fully ready to go. They found a house the next week. We closed 20 something days later. And had they had been on their own, it would have taken them a lot longer to know what to do to get that credit up. And so sometimes using someone like me I'm not a credit counselor, but I do have tools at my disposal to try and help someone. And there are going to be times where that list of things isn't going to get us there. And so I have other ideas that I can help walk through, and it might take 6 months to make it happen. But it goes back to at least having a plan of not everybody knows how credit works. Most people don't. Let's come up with a plan. So, if it's not today, you at least know 6 months from now, you're good to go. You have your plan. You've accomplished it. You might not be ready to buy right then, but you know that you can. So now you can start, getting closer to that home ownership.
Perfect. And that went right into my next question of the tools. So if someone comes to us with us as realtors with like a 550 credit score, and we send them to you, you can show them how to get their credit up to that minimum 580 or whatever they need to approve.
Yeah. So I have a bunch of different programs that I can use that will give me recommendations on what to do. And then you can always do rapid rescores and, try and force it, because what happens with credit is it normally takes 30, 60 days for a credit card company to say that a payment's been made or this has been done. I can force them to do it much quicker. So if we're on a time crunch and we want to move quickly, we can do that. But those systems are great. Now, I'll be honest, not everybody, there's not, like if you're at a 500 and have very little credit, there's not always something you can do immediately to jump you where you need to go. Sometimes it will take time, but I can at least walk you through that so I can set expectations of like, look, I know you wanted to do this now, but we can't. But here is a 6-month plan. If we can work on this during that 6 months, we can get back together, at the 2, 4, 6 month mark. We'll do check-ins, and then at 6 months, we'll do what we need to do and try and reevaluate and see if we're good to go. And at that point, it might be like, okay, now we just need to do this one little thing. We do this one thing and we're there. Or nope, we're already there and we're good to go.
Perfect. Okay. And so what is the difference between being pre-qualified and pre-approved?
Yeah. So a lot of people think they are the same thing.
Mhm.
They're not. A pre-qualification is an estimate based off of self-reported information. So when a borrower fills out an application, they're going to put in their income. They're going to put in how much money they have, like in assets. And I'm going to look at all that and say, hey, based off what you told me, you are good to go. That is called a pre-qualified borrower because I haven't verified what they told me is correct. Not that anyone would lie. Nobody's a liar, but
Mhm.
sometimes people make mistakes. And so that's what a pre-qualified person looks like. A pre-approved person is a full review of the documents to support what is put on an application. So if you say I make $5,000, I'm going to want pay stubs and I'm going to review these pay stubs to show that you make the $5,000 that you put on the application. If you say I've got $12,000 in the bank, I'm going to want bank statements to show that you do have $12,000 in your bank account. And so when I go through the process of verifying what's on the application, you go from being pre-qualified to being pre-approved. And being pre-approved always is going to hold more weight with a seller than being pre-qualified. Because
Yeah.
as you can imagine, if you were selling your house and somebody shows up and says, I am pre-qualified to buy it, you're going to know right away the lender has only been told what these people make. They have not verified anything. And not that these buyers are going to be liars, but nobody has proven that they can actually afford this home besides the buyer themselves.
Mm.
When somebody comes up and says, hey, I got a pre-approval right here, the seller's going to know the lender and the underwriter have reviewed the income, they've seen their credit, they've seen their assets, and they know that that those are real things and that they are qualified. And so being pre-approved is going to hold so much more weight than being pre-qualified.
Now, how long? Because to be pre-qualified, you can get a pre-qualification in like 24 hours, right?
I could give it to you in 25 minutes.
Okay. So how long does it take to get a pre-approval?
I would say once we get the documents, right? Like if we do the application, I request the documents from you and you give them to me. I would say it takes 48 hours.
Okay. Okay. And so with me being a realtor too, especially if I'm coming across new buyers, would you recommend for all my buyers to go ahead and get a pre-approval if I don't know them?
Yes. And I would
Um,
also recommend them, like, let's say you have somebody who reaches out and they say, hey, I want to go look at houses on Friday with you. And it's today's, today's Thursday, but let's say it's Monday, Tuesday, or Wednesday. And they're like, hey, just want to get on your calendar. Could you take me? We saw some houses we liked on Friday, Saturday, or Sunday, or something like that. You do a very good job of always pointing them in my direction. But what I would also say is, hey, you should call Jake, but you should also call him today, because if we see something we like this weekend, I want you to be pre-approved, not pre-qualified. And
okay.
so if they can do that, give me a call earlier in the week, I can have them pre-approved by that weekend. And I'm not saying you're going to find a house you love and you're ready to make an offer, but you hear those stories time and time again where people happen to find the house that they love because they've been looking at it online, or you sent it to them and they're like, wow, this is great. And that way you can be ready to go with an offer that's probably going to win versus showing up, calling me on, Friday morning, and all I can do is get you pre-qualified. And so you're looking at a house on Saturday, you're pre-qualified, somebody else is pre-approved. There's a good chance they're going to want that pre-approval over the pre-qualified person.
Yes. Okay. And I ran into this the other day with a client of mine. If we're telling them to call you to get a pre-approval versus a pre-qualification, is it okay for us to go ahead and tell them, hey, have your bank statements ready, your paycheck stubs, you'll need to send that all over to Jake?
Yeah, I would, and everybody's a little different on what's required, like how many pay stubs, depends on how often you get paid, how many bank statements, do we need tax returns if they're self-employed? So I think a good thing to say is like, you need to call Jake. You can get a feel for the numbers. I think you should get pre-approved. So go ahead and start collecting like some of your personal information that you use for taxes, like your W-2s and your pay stubs. Like if you don't know where they're at or they're not readily available online, like go ahead and start knowing that he's going to request those things. That way, when I request them, it's not a shock and they maybe already have them in a box and they know where that box is. And they're like, okay, I knew this was going to come, so I'm going to go ahead and go up the ladder to the attic and grab that box of stuff.
Got you. Okay. Got you. And can you just briefly break down what makes up a total monthly payment? Because sometimes people, I know they will get on Zillow and they'll do they'll fill out the thing and it says, their monthly payments, whatever. And then when they call a lender, they're like, oh my gosh, that's, more than what Zillow said.
Yeah. So what makes up a monthly payment is going to be your principal and interest, which is paying back the loan, right? If you have a $200,000 loan, a part of your monthly payment goes to paying that back. So principal and interest is one. Your property taxes, every property is going to have taxes on it. That's part two. Your homeowner's insurance, just like, you got car insurance, you got to have insurance to protect your home. And then potentially, if you don't put 20% down, you're going to have what's called private mortgage insurance. And so those four things are what could make up a payment. The first three, we would leave out private mortgage insurance, is what's going to be on, they're on every loan, no matter what. But then that private mortgage insurance might be the fourth piece of it, depending on how much money you're putting down and what loan program you pick. Now, you did mention something about Zillow and their mortgage rates and stuff. So one of the things that they're not always going to know is they normally estimate taxes and insurance. And when I estimate taxes, I go and pull the actual tax records from that property so I can get it as close to accurate as possible. They do a very blanket estimate. They might do 1% or 1.1%. And so that piece could be very different from what the actual taxes are. The other thing is Zillow almost always assumes you're going to put 20% down and that your credit score is a 740 and above. Now, you can go in there and play with that and it will spit out different numbers, but most people just scroll through and see, oh, mortgage payment, $1,800, that's great. And then you'll talk to a lender and they're like, oh no, it's $2,200. And they're like, what happened? And it's like, well, Zillow thought you were putting 20% down and you're only putting 3%. Or Zillow thought you had a 740 credit score and you had a 620 credit score. And so I tell people it's just like the Zillow Zestimate. Like that's not always accurate. It's fine if you want to look at it and kind of use it as a comparison tool, but just know that that's not always going to be. Every home is going to be different too on how even accurate it is, because they might have done updates to the home that Zillow doesn't know about. And so you can look at it and say, hey, that's not terrible, but don't ever assume like I've had people that look at it and then when they get my quote, they're like, oh my gosh, this is better than what I thought it would be. And it's like, yeah, great. I've had others where it's the opposite and it's just because of the inputs that Zillow uses.
Mm-hmm. And something that I love about how you work with your clients, like my clients have never got numbers from you and it been worse than, because you always overestimate, like worst case scenario, this is what it's going to be. So when they get your numbers, it's not like, oh my gosh, this is way more than expected. So yeah. I think that's really awesome.
Yeah, when I give you an initial estimate, I always err on the side of worst case scenario. And it's not because I'm a pessimist. I'm not. It's because I want you to know full well that by the time, like these are our estimated numbers now, but when we get to closing and the numbers are, hard and fast, and this is what your payment is, it will either be that or it will be lower. And so if you're comfortable here, then you're going to be comfortable when we close this loan. And when I first bought my first house, I was not in the mortgage business. I think all I could do is I could spell mortgage. And the lender was nice, but there was no it's a big reason why I work the way I work now is because the lender was very nice, but like he just took, like he was like, you owe me this much for closing and this is your monthly payment, and he didn't explain anything. So I showed up and I was like, here's my money, thanks for the keys, what is happening? Like I have no idea what's going on.
Oh my
And
gosh.
so now I work from that. I don't want my clients, you know, you could go back and look at reviews and talk. I'd let you talk to any of them. Not one of them would ever tell you they had that experience, but it's because I had that experience, and the numbers did change from the beginning to the end. And it wasn't, you know, at the end of the day, the loan officer was like, well, this isn't really my fault. You went out and shopped for insurance and your insurance was slightly higher than what, you know, I was estimating. And I looked at his estimate and I was like, well, you estimated it was $80. Like nobody gets insurance for $80. So why didn't you estimate higher than that? And he was like, well, some people do. And I didn't know any better. So I was just like, okay, well, you're right. That is, I picked my insurance. So that's on me. And the taxes were higher than what he had estimated. And he just was like, well, I had to wait to get the numbers. So that's why I even go and pull the tax records so I can be like, look, this is what they are. I'll send them to you if you want to see them, because I don't want there to be any surprises later on.
Yes. And I know specifically from my side as a realtor, the way a lender communicates is huge. I have worked with some lenders that were horrible at communication, and that's why I send all my buyers to you, because I always tell everybody he's great with communication. If he can't get to your phone call right away, he'll text you and say, I'll call you right back. You never ignore my clients. And communication in a mortgage loan or with a realtor, it goes a long ways.
Yeah.
And, like, even if something falls through and you're staying on top of that, communicating with them, it makes the clients feel so much better than if we get the day before closing and you're like, oh, sorry, we can't close because last week this happened.
Yeah. I'm definitely, you know, proactive when it comes to communication. If there is anything that could potentially happen, I want everyone to be aware of it so they know and are on, you know, 3 minds are better than 1 mind. And it's like, I might think, well, we can solve this, but if I get everybody involved, we could probably solve it faster and better. And so I'm a big fan of that. But also, buying a home, you're buying your largest asset that you will probably ever buy. It's also your largest liability that you will ever buy. You know, not many people are out there taking personal loans for $200,000. And so not only is it the best asset and the largest asset you'll buy, it is probably your largest liability that you will ever have. And I take that to heart when I think about somebody doing this. It can very easily go how mine did, right? Where you're like, well, it happened and I got it and it wasn't super painful, but you don't understand it. If you're going to make the conscious decision to buy a home, I want you to understand it, because it is not only an asset, it is a liability. And I want you to know how to best service that liability, what you can do to better yourself with it, all of these different things where it's like, and the only way to do that is to communicate it. And I'm very much a teacher by nature. I have a 3-year-old son, and like, I love teaching him things, but I've always been that way. And it comes across when I do my job, because of the fact that like, there's nothing better to me when I talk to somebody and I'm starting to explain something and it clicks for them and they start explaining it back to me. And I'm like, yes, you fully understand this and I have done my job.
Yes. Amen. And speaking of communication, what is your communication style? Do you like to text or email, or?
I'm a chameleon on that. You can't see it because I'm on my computer, but I have 3 screens right here. And then I have my cell phone right here. And so if you're an emailer, I'm on my email all day. If you're a texter, I text all day. I love phone calls. A lot of people don't love a phone call, but there are times in my world where a phone call is better to explain because it gets lost in translation versus text and email. And, but if it's just quick updates, it kind of is a natural thing. I'll notice with certain clients that they'll text me and say like, hey, just checking in, or, hey, I have a quick question for you. So then I'll meet them where they're at and I'll text them back. And then if that question is a long-winded question, rather than text them, I'll probably call them and be like, hey, do you have a few minutes? Let's just talk this one out. But I'm good with any and all of it, but I tend to meet people where they're at. If they email me and versus texting me, they're going to get an email back. If they text me, they're going to get a text back. But I'm not opposed to any of it. So,
and I could not agree with that more, because I think so many people, their way is the only way, you know, they only want to talk on the phone, or they only want to text. And when we're in the customer service business, like we are, the people business, we have to meet people where they're at, because some people, I don't care what you do, they are not going to pick up the phone and talk to you, you know, or some people are not going to send you a text message. They're only going to call. And if you're somebody that's dealing with people and you only want to talk on the phone, or you only want to text, it's kind of a disservice to your clients.
Mm-hmm.
And how long does the full loan process usually take from pre-approval to closing? Usually,
I would say for us, probably somewhere between 21 and 30 days. I can do it faster than that, and I can do it slower than that. And when I say slower than that, some people are like, why would you ever do it slower? Well, so much of my world is verifying, right? We have an application with data in it, and now I need to get documents to support this application, right? Like, you're going to give me your name and your birth date. Well, I got to get a driver's license to show that that's your real name and that's your birth date. You know, your bank statements, your pay stubs, all that is to verify this one application over here. And so if I ask you, hey, I need another bank statement, and it takes you a week to get it to me, well, then it makes it hard for me to close in 21 days when it takes a week to get things. And so I've got clients that, you know, if they want to close in 21 days, I can get you a clear to close in probably 10 if I say, hey, I need your bank statement, and an hour later I have the bank statement. Well, you have a pretty good chance that we'll be cleared to close very early, probably before we even need to be, which is fine. That's my whole goal. If we're closing in 30 days, I want us to be fully done with this at least 7 days to 10 days beforehand. So that way it's like, hey, if we want to close early, we can. But otherwise, for the next 10 days, you already have enough going on, right? You're probably packing and moving. You're trying to set up, you know, internet and lights at the new house. The last thing you need is for me to be like, hey, you mind if you send me another bank statement? Like, you got enough going on. So my goal is to get it done early, so you're just kind of able to go about your life knowing that the money piece is done.
Yes. And so what is your biggest piece of advice you would give to someone who wants to buy a home, but they feel super overwhelmed?
Honestly, it would be to call me because this sounds cliche, but like, the home buying experience, it's big, right? There's 100 things going on. And it seems like a lot, but if done correctly, it's really not that bad, right? There might be a day or two of like, wow, I have a lot of things I need to gather for him, but it's like going to the dentist, right? Like, you know, root canal is never fun, but after it's over, like, you got no more pain the rest of the time. So rather than having it being like, well, my tooth hurts for the next 6 months, I can go, you know, have a pain right at the front, and then it's easy moving forward. And so I kind of pride myself on like, look, when we have our conversation, knowledge is power, in the sense that like, when you understand something, it's not scary anymore. Exactly. And so if I explain it and, you know, we go through it and there's no bad questions, and if you don't understand, we keep talking through it, that conversation, you know, it might take 45 minutes to an hour to really understand where we're at and what we're doing. And I'm happy to make that investment, because I want you to be well informed so that way it isn't scary and you're not just like holding on the whitewater rapids of like, where are we going? Like, what's happening? It's like, no,
Yes.
you got a paddle now, and you're going the same way we're all going, and we're going to get there, and it doesn't feel overwhelming.
Yes, and it doesn't have to be as hard as some people make it. If you stay in constant communication and you're willing to talk things out, it can still be stressful, but it doesn't have to be as stressful as sitting around and not knowing what's going on, not understanding what, like you went through, not understanding your mortgage. It doesn't have to be like that. And that's why it's so important to choose a great lender, to choose a great realtor from the very beginning. So by the time you close on your home, you're not needing to go to the bar afterwards. You can just enjoy having a new house.
Yeah. And that's like one of the biggest compliments I feel like either of us ever get is like when you're at the closing table, like, man, that was easy. Like this was like kind of fun. And you're like, you know, they're probably not going to want to do it next week because they just bought a house. But at the end of the day, they're like, this wasn't bad at all. And it's like, yeah, it shouldn't be.
Exactly.
Now, sometimes there are things that are outside of our control that make it feel a little rocky. But at the end of the day, if everybody's working, the sellers, the buyers, the lenders, like when you get to the table, it's kind of like a party. Everybody's like laughing and joking and like, this was great. And it's like, yeah,
yes,
it should be.
Amen. Well, thank you so much for taking the time out of your day today to let me interview you. I appreciate it. And I hope you have a great rest of your day.
Yeah, thank you. I'm happy to do it. And this was fun. So thanks.
Yes, thank you so much. I appreciate you. Have a good day, Jake.
All right. See ya. Bye.